All right, I'm going to walk through number 37. Number 37 is a commitment, and this commitment is a forward contract. You can have a commitment that's a forward contract, and you can have a commitment that's an option. So basically, the difference between a commitment and a regular transaction is the day we hedge. On a regular transaction, let's just take their dates. This isn't the story they're going to tell us. But on a regular transaction, title passes on October 1st and we hedge on October 1st. On a commitment, we place the order on October 1st, but title doesn't pass until later. And so we're technically signing a contract on the hedge at the same date we say did a purchase order. Okay, so let's read this a little bit. And so on October 1st, Sharp Company based in Denver entered a forward contract to sell 100,000 rubles in 4 months and received 39,000. Exchange rate is as follows. What's this? Okay, so I had to look at this a little bit because they haven't done the regular transaction. But A and B, I honestly want to look at B because B is the firm commitment. A is prepare the journal entries assuming that Sharp entered into the forward contract as a fair value hedge of 100,000 ruble receivable arising from a sale made on October 31st. Include both entries for the sale and the forward contract. So A is a regular transaction and B is a firm commitment. So notice in B, they entered it in on October 1st on a sale that will be made on January 31st. So notice I'm hedging before title has actually passed. So I'll do the first one rather quickly because we've gone through the regular forward contracts pretty often. Okay, so if the sale happened on October 31st, I have accounts receivable sales. I have 100,000 foreign currency units at 35, so accounts receivable sales for 35,000. So that goes on the regular side. On the hedge side, I just sign an agreement. This is a forward contract, not an option, so there is no entry. On the 31st, I need to adjust my accounts receivable from 35 to 38, so accounts receivable is going up by 0.03. So I probably should have put accounts receivable here. Got accounts receivable sales transaction. So I'm going to collect the foreign currency, so then I'm going to sell the foreign currency. So that's kind of important there. And I've signed the agreement to do it for 0.039. So I really want to get my cells there anyway, but I should have draw a box around the 0.39 on your paper. All right, so accounts receivable needs to go up by 3,000. So I have a gain. Now I need to do this one. If I go back to the problem, you'll see that they want to do a fair value hedge, not a cash flow hedge. So I only have one journal entry. I need the loss or adjust my forward contract. So I've signed an agreement to sell it for 0.39, and I have to do it since it's a forward contract. Had I waited to hedge it, I could have sold it for 0.41. I would rather sell it for 0.41 than 0.39, so I'm worse off, so I have a liability. So I'm going to credit my forward contract and debit loss. And now we're going to work on the amount that is in there. So notice that I have 0.41 minus 0.39. Again, the direction doesn't matter. So I have 2. So 0.02 is my difference times the 100,000 foreign currency units. I have $2,000. But notice that this is December 31st, so I'm not going to settle it until 1 month later. So again, I'm going to bring it back from January 31st to the date we have it. I'm using the present value. This is not like the premium or discount where I amortize it over the months past. And the problem tells me that the factor for 1 month of 12% is 0.9901. So I take my $2,000 times my 0.9901 and I get 1980.20. So remember, it was a liability since I would have rather done it for sold it for 0.41 instead of 0.39. This would be flipped if it was buying foreign currency, but it's not. So I have loss on forward contract, forward contract. Again, if this were a cash flow hedge, I would go through the 3 steps of offset this gain or loss, adjust the forward contract through AOCI, and amortize the premium or discount. In this case, it's a premium since it's higher. And then I would have to ask myself, is it going to be a revenue or expense? It's a revenue because I could have sold it for 3.5 and my contract says I can sell it for 3.9. So I'm basically making 4 cents of revenue on this, 0.04. All right, then the next transaction on the 31st, January 31st, it's sitting, accounts receivable sitting there at 0.38 and I need to adjust it to 0.40. So that's up by 0.02. So to make accounts receivable go up by 0.02 times 100,000, I debit it and I have a gain. Again, this is a fair value hedge, so I only need to adjust my forward contract. So notice that the forward rate on the date of sale today is today, so the forward rate and the spot rate are the same. So now I'm going to look at my entire difference here. I'm going to leave that up there because that's what my forward contract is sitting at. My entire change is 0.40 minus 0.39. So I have 0.01 and I have 0.01 times my 100,000 foreign currency units. So I want it to be 1,000. It's sitting right now at 1980 on the credit side. Go back to here. See, it's credited for 1980, and I need it to be, let's figure out if I need a debit or credit. Would I rather sell it for 0.39, which I have to sell it for? Again, yours has a box around it, mine doesn't. Or would I rather sell it for 0.40? I'd rather sell it for 0.40, so I still have a credit of $1,000. But right now I have a credit of 1980, and I want a credit of $1,000, so I got to take 980 out of it. So a debit forward contract for 980. Hopefully you make it your T account and you actually see that it's still got a $1,000 credit balance. But anyway, and so I have a gain. Then I settle the thing. If this were a cash flow hedge, again, I'd have my 3 entries instead of my 1. Now I have to settle it, and so I get collect my foreign currency, which is worth $40,000. So I'm still on the regular transaction side here. I usually put these in the middle between the 2 columns, but technically this is I'm settling my regular transaction. So I'm getting the foreign currency for my accounts receivable, and then I have agreed to sell it for $39,000. So I get $39,000 for it. I get the foreign currency off my books, and the forward contract has a balance of $1,000, so it should all work out. The impact on net income is the sales, and you'll have your related cost of goods sold in real life. Then I have my gains, my loss on forward contract, etc. So here's my, quite frankly, my impact of the foreign currency transaction. As I've said before in other videos, that they do not have the cost of goods sold here. So I would prefer they hadn't put the sales because they haven't told us what the cost of goods sold are for. So the impact on net income is whatever this is minus cost of goods sold. All right, so now let's switch this and say, all right, what if it's not a transaction? What if it's a firm commitment? And a firm commitment is on October 1st, title didn't pass. Inventory was not shipped. I just signed a purchase order. Okay? So like the forward contract where I don't have an entry on this date here because all I did was sign an order, I don't have an entry on either side. So on October 1st, there's no entry because all I did was sign a purchase order. On the hedge side on October 1st, there's no entry because all I did was sign a contract. All right, however, go back to the problem here. Okay, this last sentence is pretty important. The fair value of the firm commitment is measured by referring to changes in the forward rate. Okay, some other problems will say the fair value of the firm commitment is measured by referred to changes in the spot rate, although I think most of the problems in here have forward rate. But the option will say spot rates, but please pay attention to this, okay? I am going to have the firm commitment referring to changes in the forward rate. All right, so on 10/1 there is no entry. Then on the 31st, this will be on the forward contract side, right over here. okay? Where I have my forward contract goes down to 1980, just like it did in Part A. So there's that journal entry. If you missed how to compute it, go back and see the steps in Part A. And then my firm commitment, since it was placed on exactly the same date for exactly the same amount of foreign currency units, and the problem tells us they follow the forward rate, this is going to offset. So this loss will be offset by a gain on the firm commitment. The firm commitment is technically the firm commitment to make the purchase. So it is technically on the regular transaction side. I tend to put it on the hedge side because it follows the forward rate. All right, then on January 31st, again, I have my forward contract, just like the prior problem. I've got to go from 1980.20 down to 1,000, so I've got 980.20, and this was a liability, so now it's less of a liability by debiting it. And then my loss on firm commitment also follows the forward rate, so it's going to be exactly the same but flipped. We'll have, if this is a gain here, this will have a loss here. So again, it technically is the commitment on the purchase order, but I tend to write it over here because it follows the forward rate. So you do it however you want. You want to put it over here, but just draw an arrow somehow. And then I settle it. And notice on the 31st, what happens technically on the 31st, the journal entry for the sale is made because title passes at the same day I'm paid. So they don't ever hedge up here for the firm commitment, have title pass on a different day, and then settle it later. They either enter into the forward contract on the same day as title passes or pay for it on the same day as title passes. All right, so then I get my foreign currency. So notice I'm right here. I generally write this is settlement right here. This is how I settle the thing. I usually write it in between the two because I'm settling both of them at the same time. All right, so I have my sale. I record my sales. This is generally accounts receivable sales in prior transactions and regular transactions. But in this particular one, I'm collecting on my foreign currency on the same day I make the sale. So I debit foreign currency, credit sales, and then I settle my contract. I've agreed to sell my foreign currency for 39, so I debit cash for 39,000, get my forward currency off my books for 40,000, and I adjust my forward contract, which should be at $1,000. Okay. Then one other thing I need to get off my books is my firm commitment. So my firm commitment is also sitting on my books for $1,000, and I need to get it off. This $1,000 is technically what I put it here. Put it in sales. Okay, so notice I made the sale on this date. Okay. Notice they say adjustment to net income. You might even have an additional sales amount. So it's the sales is going down in this case. So foreign currency adjustment to sales of $1,000 and firm commitment. If this was inventory, it might go to cost of goods sold, when some of it may stick in inventory, whatever it is. But remember, this has to do with the actual sale. So this is my sale has, just like sales returns and allowances, a contra sales account. This is a contra sales account. So what is my impact on net income? Notice these two offset each other, and so I just have my adjustment to net income of the $1,000. That changed. So hopefully that helps.